GKFX Prime presents the Market Analysis Webinar. Hello everybody, welcome to this Market Analysis Webinar. I hope you had a good weekend, ready for some good trading this week. I have to say, when I was recording this last week, I never could have anticipated that level of volatility. That was one of the craziest weeks in markets I've seen in my trading career. I was around for the market moves in 2008 in the financial crisis, and that was certainly well up there with it. Those limit day downs where the stock market got cut out at 7% declines on the New York Stock Exchange. 10% plus daily drops in some of these major indices was just absolutely crazy to watch and to participate in. So let's start with the stock market, because I think that probably is the most interesting in terms of the moves taking place, but certainly there was lots going on in currency markets, which we'll cover too. We will cover currency markets, commodities and indices. Now, of course, if there are any other markets you want me to cover next week, please feel free to let me know, and I'll be more than happy to add that to the routine here. So let's start with this SP 500 as we trade it, or the S&P 500. Now, this is our normal daily chart. You can see these were that was the opening gap that we started with last week. We tanked into the bear market zone. We got a little rebound off there, but then we soon crashed right through the bear market zone, and in the next couple of days essentially dropped another 10% and came just short of the 30% pullback. Now, to explain this a little bit more depth, let me go over to our monthly chart, and this is nicely timed so that here's our low from 2009, the end of the financial crisis, right up to this peak where we've recently peaked out at. Now, our traditional Fibonacci is the way we use this tool here, the Fibo tool, is with the main levels 38, 50 and 62, and the closer decimal versions of that. What I've done here is I've modified this longer Fibonacci here, so I've got two sets on, and I've changed it to 20, 30, 40, also 10 and 50 instead of those usual Fibonacci levels. And what I've done in terms of the parameters is I've started it at 0. So now when we're talking about a bear market being a 20% pullback, it's correctly defined on our chart, and we can see that level. So there's that 20% bear market zone, and then there's the 30% zone. And you'll see that the 30 level nicely lines up with the 38.2 on our traditional Fibonacci from the 2009 low, and then it keeps working. We drop down to the 40% pullback, so from 0 to the highest ever peak, 40% down from that corresponds to our 50% from the 2009 low. We drop down again, the 61.8% Fibonacci from the 2009 low matches up very nicely with our 50% pullback of our all-time peak. So what's the conclusion there is that if we do see lower prices, the likely targets are these zones here, which if I use the crosshairs tool, we can see is around about 2050 and then about 1700 are the big round numbers involved if we are to see further declines, which seem very much feasible after last week. Now you can see on the weekly chart we've got that big bounce off the lows, so that suggests that we've got some potential for some sideways trading given the extent of that bounce. And then again we can drop back to the daily chart where we started, and so now we can make a bit more sense of what this 20 means, what this 30 means, and indeed the 10. The 10 level is, remember, if 20 is a bear market, 10 is what we call a correction. So I think that if we can, depending on how we trade for Monday, is how we'll trade for the rest of the week and thereafter. If we can hold above the 20% bear market zone, I think we can actually push back up towards the correction territory zone of 10%. But if we don't, I think we're back down towards the lows, and I'd be surprised if we take these lows out this week, but certainly given the extent of the declines and the volatility, it's possible. And if we do, that's when we start eyeing up this 40% correction zone, also the 50% since the 2009 low and the start of this most recent bull market. So that's what I think we are dealing with in the stock market. Now let's switch gears back to the currency market. Now what's interesting about the euro is that we actually have a candle pattern here on the daily chart. This is a tweezers bottom. We can see there's been a long wick to this daily candle, and then the next day also has a long wick, and it's stopped at exactly the same level. And if you can see, if we take the low to the high, it's perfectly the 61.8 Fibonacci level. So I think this is a setup right up in itself. I don't know if it means we go all the way back up to this previous peak. It quite possibly doesn't, but we can target this resistance zone from these two previous peaks, which for your information is in and around the 125 zone. So 125 being the round number, of course. If we add in our line, there it is. So that's potentially a setup here. We've been quite, obviously last week was a massive risk off week and people went into the dollar as a haven. And so if that is to continue, then this bounce won't last too long if it indeed happens at all. And this is a decent setup in that if we dropped anything substantially below this 61.8 level, we know that this trade's probably not going to work out. We've got this area of support below, just above the 72.6 level, around the 110. That is a potential support for the market to bounce again below there, and I think we're heading probably right back down to the lows of last week, around that kind of just above 108. I think we did take out 108, didn't we? So 108 being the round number to watch out for if we get through that last layer of major support, I believe. So bias for a little bit of an uptick, and then if we do get the rally up towards here, eye up the price action around 112.50, because potentially that's where we turn lower again, and we eye up firstly the 61.8 support, if indeed that does turn out to be support, and then the 110 again. General picture here is that we potentially are getting a bullish breakout, but it's very volatile markets, and for the time being we've had basically a false breakout to the top side. So we could get some resumption of that breakout, or we could turn right back down to the lows again. So we've got to be willing to trade in both directions on the currency market at the moment, in particularly the euro. Over to the pound, so a slightly different idea on this in that we've not come into the major support level yet. We've paused at 123. The next major support was at 122. We've absolutely fallen off a cliff. We don't really want to be necessarily catching a falling knife. And the best kind of comparison that we can kind of make in terms of potential price setup here is how we've dropped sharply here. Look at this rally up here. If we take the peak of this rally, we can see it was around 130, and then the drop was to just below 128. So a 200 plus pip pullback. So if we get the same thing here, 23 would take us to around 125. This is this previous resistance through here. So somewhere between 24 and 25 seems like a reasonable area to at least look for some sort of pullback out maybe of this oversold zone, then for the trend to resume, and not even to 122, but quite potentially down to 120, which was that major support. And if we remind ourselves on a weekly chart, we can see that's kind of what we're dealing with. Again, we kind of had that false breakout from 133. The market wasn't quite able to close above there, and we rolled over. We came up to try and get through it again a couple of times, failed, and that's when we had this dramatic down week. And so now we're probably aiming for this longer term support, which comes in at the 120 level. So looking for the short pullback to start with. Obviously, if we blow through 125, then we've got to start thinking that this is going to be a longer pullback, which is entirely possible. As we said, it's a very volatile market. I will just quickly throw in this level here, which you can see to kind of demarks these peaks. So if we're going through a bigger pullback through 125, look up towards 127.50 to 128. Let's switch gears to dollar yen. So much volatility in this pair because obviously the yen and the dollar both fighting for that flight to safety. And so there's not too much of a trend going on here. We had mentioned in last week's webinar about the Bank of Japan defending the 100 level. Don't know if this was the Bank of Japan overtly, but they did introduce some much more proactive language about the kind of policy tools they were going to fight this coronavirus crisis with. And so that helped the strength in the yen, which had obviously this market dropping is the yen strengthening, and we saw a big reversal of that yen strength for a lot of yen weakness last week. Part of it was the Bank of Japan saying they'll just do whatever it takes to shore up the Japanese economy. Whether they can do that or not is obviously part of how we determine where to go from here. I actually tend to think that maybe we are looking for an opportunity because given it's a sort of range-bound market, I'm looking for a bit of intermediate resistance here, which I think is a little bit above where we finished at the week, up in towards the 110. So you can see that 110 has been significant in the past. It's not always exactly the level. Sometimes it's a bit below, sometimes it's a bit above. I think possibly on this time just a bit below. Maybe at the start of the week we nudge a bit higher and then roll over to retest 105. That would be something in the range of 500 pips were we to get it. So it might not happen in just 1 week, but given the current volatility, it's possible. If we push through 110 substantially, then that to me would suggest that we push up to the 112s, the 112.50, which was this prior resistance. And again, we're still pretty much in trading, in a trading range, and it's only below that key 100 level, which the Bank of Japan have sort of indirectly been defending, when we start to see some major yen strength, major dollar yen weakness. That still seems like an ultimate destination to me, but we're not quite there yet. Big spikes trying to push us away, but you can see each time the peak is just slightly lower. Let's move gears to the Aussie dollar. So worked pretty nicely last week in terms of 67 was the support. We broke down through the support. We rebounded, retested the support at 67 and dropped right down to 62. So that was just 500 pips in 1 week of just classic technical analysis. Break, retest, drop 500 pips. Bob's your uncle. Doesn't always work out that perfectly, but it did in that Aussie dollar pair. That was pretty sweet, and a good indication again that just because we hit 65 and we got a little bit of a rebound off 65 doesn't mean just because we hit a round number that the bottom is in. We did obviously get a rebound, and if you'd bought 65 and traded up to 67, you made 200 pips on the upside there. But if you're with the trend, it's always the most profitable until the trend ends, which only happens once. And we got that 500 pip to drop to the downside. So with the same principle again, we got this low in here. If we call the market drop around 62, about 200 pips higher up above 64 into this previous low, that could be the area where we roll over again. Obviously, a bottom's going to come in at some point, but it doesn't seem like we're quite there yet. Dollar CAD. Let's look at this on a weekly basis now. we talked about this 137.50 to 138 being a massive area of resistance, and we have pushed up through it. You can see on this weekly chart that we gapped up through this resistance area here into here. And so this gap potentially gets filled on a bigger pullback, but I tend to suspect that 137.50 would be the first kind of natural area, and we've already done that as of Friday. So we've got that pullback to there. So potentially we're already at 138. We're potentially a one buy area if this trend is to continue. But I tend to suspect that maybe we go a little bit lower here, and it would be a better entry point if we could trade in around 136 and this previous area of resistance down here. If we drop below 136, I think we fill the gap, and we're kind of into a failed breakout kind of territory then, and we possibly head back down towards the lows. But it does look like we had the big bull run, we've had the correction, and the market has obviously tested this level once, dropped down, made new lows, tested the level again, pulled back, but the low was substantially higher this time, and we're back up and we're through it, in fact. So it looks like we're pushing to the top side here, but the market is obviously overbought on multiple indicators, so we're going to get some size of pullback, and that could be our opportunity to buy into this long-term upside break. Brent crude oil. So we did actually manage to kind of vaguely cling on to the lows last week. So we basically had the low. The bottom fell out, obviously. We gapped down through 45 down to 35, and then below there we held on to just above 30 in Brent, and so far we've kind of chopped around above there. I think potentially, and this is a daily chart, potentially we're able to fill the gap up to 45. So you can see this is our weekly chart. We've obviously just hammered straight through all these levels. We haven't got down to the 27 low that was reached in 2015, but that could certainly be a destination. We've held on to 35. Judging by the shape of that last week candlestick, where we kind of pushed down, then we pushed up again, and we finished right where we started, suggests maybe some range-bound tradings to come. If we can fill that gap, get through 40 up to 45, then from 45 we maybe come down to 35 again, and maybe it's this kind of diagonal trading that we're dealing with for the time being. That's one possibility. If we just start trending lower again and we take out 35, then it looks like we're going to go down to 30 and eventually that 27 point. And last but not least, let's talk about gold. Not behaving as you would necessarily think it would. While stock markets are crashing, there are obviously more dynamics than just haven flows that help investors decide where to put their money. That's been supporting gold more recently, taking money out of the stock market, putting it in gold as a haven. But the moves in the markets last week were so insane that people were using gold as a winning position to cover their margin calls in the stock market, and so closing out winning positions to cover losing positions in effect, which is not great trading. And we talked about this at the end of the previous week when we saw that pullback, and I said that looks like a slightly bigger pullback than I would normally expect in a bull market. Potentially we're dealing with a double top, and so I don't remember if I actually called the double top or not, but not either way. 1700 pretty much has been the top from here, and so if we say that's one peak, that's another peak. If we call this zone roughly the neckline, say we aim for a push back up into the neckline, ideally around 1550, and then what we're basically dealing with is a conservative from this zone to this zone, sort of the middle of both, and then from that line somewhere down towards probably just above 1400. which just happens to be, if we look on the weekly chart, happens to be the bottom of this area of consolidation here, but it's above the 1370, which if I zoom out a little bit, you can remember is that kind of major support level. Still longer term, I think if we hold above 1370, gold's still okay. So that pullback to 1400 gives people an opportunity to get into gold if they hadn't already done so. So that would be just above 1400 would be the destination if we are dealing with a double top here. A more conservative target would be 1450, which is where we ended this most recent consolidation pattern. Okay, that's it for this week. Let's look forward to some more fascinating trading. Thank you very much for listening, everyone, and good luck for the week.